10 years from now, that $4,000 a month will buy $1,000 in goods and services. In other words, they will inflate away the real value of the obligation while paying the nominal value of the obligation. Anybody who lived through the decade of the 70s watched this happen in real time. That is, I don't see any way out. Dunnigan, this is just, for me, an inescapable mathematical truth.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 19th through May 26th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted and honored to have this returning guest, Rick Rule, formerly the CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Monday, May 19th, 2025. Rick, thanks for coming back on Liberty and Finance.
Pleasure to be with you, Dunnigan. Thank you for having me back.
You cast a long shadow in the world of precious metals and financial, let's just say natural resource investors. And they look to you for guidance, not only in awareness of which natural resource companies are perhaps most worthy of their closer inspection at this time, but also on philosophies learned through, as you have put it, a lifelong labor of sweat, tears, and blood of being a very involved, engaged, and investor who did perhaps more due diligence than almost anyone else. And we're grateful for your presence here. We got, as always, a snowstorm of questions that have been submitted ahead of your arrival. I've tried to group them into the following categories. The first is market direction and monetary direction. The next is property rights, gold-silver ratio, resource stocks, and battle bank. So with your permission, I'd like to plunge ahead in our way that we do sometimes rapid fire, and feel free to take any of these as far and as deep as you'd like.
We'll do as much as we can. Let's go.
All right. Market and monetary direction. Mr. HVAC guy says 30-year yields are back over 5%, almost back to that of October 23 level of about 5.15%. Do we go higher from here now that the debt has been downgraded?
I think that's a really interesting topic, and I should start with the headline answer. I don't know. It is interesting, I think, for two reasons. The Fed and the politicians would prefer lower interest rates, and they're doing everything they can to buy down the front end of the curve. For the last 40 years, buying down the front end of the curve has worked the lower end of the out end, the long end of the curve, lower. That's not happening anymore. So it would seem that we're seeing the return of what Clinton termed the bond vigilantes, which is to say that the market seems to be controlling the long end of the yield curve rather than the politicians, which is an interesting set of circumstances. I suspect that if interest rates were left to the market, that interest rates would be much higher. Dunnigan, we've discussed on your show before the interplay between the deterioration of the purchasing power of the U.S. dollar and interest rates. If you believe that the CPI stated rate of inflation at 2.5 is accurate, then a 5% long-term yield is adequate. You're getting a, 2.5% real yield net of inflation in a riskless asset. If you believe, like I believe, that the deterioration of the U.S. dollar, the purchasing power of the U.S. dollar is more like 7.5 or 8%, then current yields still aren't sufficient. You're being paid 5% in a currency that's deteriorating in terms of purchasing power by 7.5 to 8, which is to say you are losing 2.5 or 3% on your money. it would appear that both private savers, afraid of this math, and foreign governments, both afraid of the math and tired of the weaponization of the U.S. dollar, are less aggressive buyers of U.S. treasuries than they were in the past. Where does this end? The truth is, I don't know. We've had 40 years, the period 1982 to 2022, of very benign times for the U.S. dollar and the U.S. political system. My suspicion is that that's over for a while. My suspicion is that things become more turbulent. And interest rates, in addition to being subject to political manipulation, are really a function of confidence. And enough confidence still exists that people still tell you, with regards to equity markets, as an example, buy the dips. For myself, I wouldn't buy a 10-year treasury or a 30-year treasury at any interest rate that didn't offer me a 200 basis point or 2% real yield in excess of what I see as the decline in purchasing power of the dollar, which is to say, I wouldn't buy a 10-year or a 30-year that didn't have a yield that was 9.5 or 10. I'm way off market myself.
Another question here regarding market direction, and that is from Kevin D. Bello. Says, I'd love to know Rick's opinion of the melt-up or bust hypothesis. I guess we're talking about that when people finally come to wake up, John Q. Public, that the dollar's, as you say, losing increasingly of real purchasing value. There's a flurry to dump dollars and buy anything real. What are your thoughts about that expectation, and any idea where we might be towards it if you believe that's going to happen?
The question is, what might one buy? The U.S. dollar, I think, will do relatively well compared to many other fiat currencies. I believe that savers probably need to build a diversified base of short-term currency savings accounts, more than one. I am heartened by the fact that there's still a lot of liquidity in the system. And if that liquidity decided to come into any particular segment of the market, that segment would do well. There are literally trillions of dollars sloshing around looking for a home. In answer to the question, which is to say, if people become afraid of the stability of the U.S. economy, the first thing I have to say is, where will they go? Perhaps they just go on strike and save. I remember very well the period 1968 to 1982, the last period of serious debasement of U.S. purchasing power. And with the exception of gold and resources, not very much did well. We had a 14-year period where equity markets were stagnant and bond markets got clobbered. Is that going to happen again? I don't know. I, on the one hand, am afraid of the fact that we are going into a period of increasing volatility with much higher government debt. That part scares me. At the same time, we are going into it with an immeasurably stronger private economy. The increases in productivity that we have achieved from technology is spectacular. We can do more with less capital. I suspect that these two countervailing features, the incredible strength of our private economy and the incredible stupidity around our public economy, will interact with each other the way two great big weather systems interact with each other, that will have an awful lot of volatility, an awful lot of sound and fury. I wish I could tell the questioner how it's going to end up. I don't. For myself, I try to buy the equity of very high quality companies that I understand. I don't buy the market. I buy individual companies. I do a lot of savings in gold, a financial asset that isn't simultaneously somebody else's liability. I also maintain liquidity in several currencies, currencies from countries that I invest in or like to visit. And I invest in two sectors that I know extremely well personally: conventional financial services and natural resources. Whether or not this is an optimal strategy, I don't know. It's the only one that I personally am comfortable with, and it's the only one that personally goes to my strengths.
Speaking of saving in metal, as you've put in the past, volatile liquidity, Mustang writer asks, he says, I've got my gold, I've got my silver, I've got everything for my family, land, food, seed, and ammo to secure it all. For some reason, in my prepping mindset comes to the conclusion that we have two types of dollars. One is Federal Reserve notes, debt, and the congressional dollar coins. So instead of stashing away paper currency, I now stash coins by the box. I believe these coins are true U.S. dollars. The paper one's a banking consortium note. My question, if there is a dollar revaluation, let's say after the revaluation now takes 10 current dollars to get one new dollar, wouldn't my dollar coin still be worth $1 each since they're the coinage backed by America's assets and resources? Am I thinking right? I ask better minds.
No, you're not thinking right. The government doesn't particularly care about the rule of law in a bad situation. If the coins that you're storing have melt value in excess of their stated value, then, except for the problem of liquidity, which is to say you have to transfer them for something that you want, which is an extremely inefficient process, it is important that you maintain liquidity in U.S. dollars too. I know this sounds odd because there is a risk, I think, a risk in the very long term of a currency reset. The problem is that we have to live right now. I maintain substantial U.S. dollar liquidity, even though I know that having those dollars invested in very, very short-term obligations, certificates of deposits from solvent banks, short-term U.S. treasuries, although I know that I'm getting paid 4.3 or 4.4% interest in a currency where the purchasing power is deteriorating by 7.5 or 8, I know, too, that I have to maintain liquidity. I've lived through several episodes of illiquidity, including that famous panic of 2008. And having the cash gives one both the tools and the courage to take advantage of that circumstance rather than being taken advantage of by that circumstance. So by all means, save in gold. By all means, if you are concerned enough, save in silver coinage without any sense that the government will back that coinage because of their, quote, promise. But also maintain liquidity in the currency that your life is denominated in, which is to say the U.S. dollar, in very short-term obligations. Don't go out past 3 years on the yield curve.
Transitioning into property rights, we have a question from Cheap Laugh Kennedy who asks, how much longer can the debt-based expansion continue? Wondering if all debts are mathematically impossible to repay, does that make the currency worthless, or is endless debt an asset?
Endless debt is not an asset, but the problem will resolve itself slowly over time, the same way the problem resolved itself in the decade of the 1970s. In the 1970s, according to the Congressional Budget Office of the United States, then called the Office of Management and Budget, the purchasing power of the U.S. dollar declined by 75% in 10 years. The nominal value of debts, including government debts, stayed the same. But the net present value, the real value, fell as a consequence of the deterioration of the dollar. It's important to note that. And I suspect that's what happens this time. Let's look just for fun at the arithmetic. The aggregate private net worth of American citizens, according to the IRS, is $141 trillion. Pretty good. We're rich, right? The on-balance sheet obligations of the U.S. government, just the U.S. government, not federal, state, not state or local governments, not private debt, not corporate debt, that number's $36 trillion, about to be $37 trillion. By itself, that's likely manageable. The off-balance sheet liabilities of the U.S. government, however, Medicare, Medicaid, Social Security, federal pensions, military pensions, all that stuff, that's $100 trillion. Add those two numbers together, 36 and 100, you come with 136 trillion. Now, subtract that from the aggregate net worth of Americans, 141 trillion. The number that you have left over is not a big number, but it gets worse. Every year, the on-balance sheet liabilities of the U.S. government get worse by $2 trillion a year. And the off-balance sheet liabilities, the net present value of looking after old folks like me, increases by $2 trillion a year. In other words, that $136 trillion number gets worse by $4 trillion a year. I'm going somewhere with this, by the way, Kaiser. This isn't just a rant. The big thinkers in Congress say tax the billionaires, increase the taxes on the billionaires. Here's another problem. The billionaires have an aggregate net worth of $6.7 billion. So if you stole all their money, not taxed them, stole all their money, you would solve the problem, not the debt, just the increase in the deficit. You would fund the federal government for less than 2 years. So what do? Do we say to old guys like Rick Rule, who paid into the system for 60 years, too bad, so sad, no benefits, strong letter to follow? I think we fiddle around the edges, actually. I think we change the eligibility requirement. I think we make old, fat, rich guys like me pay Social Security on their full income as opposed to merely on the first $160,000. I think, too, we means test Social Security. And so although we steal 6.2% a year from the Rick Rules, we don't give them any money. I mean, I think we do that. It becomes redistributive. But it doesn't matter. Playing around the edges does not matter. Arithmetically, it just does not matter. What we do is we inflate away the net present value. Rick Rule has been promised whatever it is, $4,000 a month or something in Social Security. They will continue to give this old, fat, cranky libertarian $4,000 a month. But by the 10 years from now, that $4,000 a month will buy $1,000 in goods and services. In other words, they will inflate away the real value of the obligation while paying the nominal value of the obligation. Anybody who lived through the decade of the 70s watched this happen in real time. That is, I don't see any way out. Dunnigan, this is just, for me, an inescapable mathematical truth. And I think it's really important that this person asked this question, because I think your viewers need to understand that the Commonwealth isn't going to look after you despite their promises. You have to look after yourself. It's just simple arithmetic. If you think that retiring on $1 million today is going to fund you sufficiently over 10 years because you can generate a 5% nominal yield, $50,000 a year, understand that $50,000 10 years from now is going to buy you $12,500 worth of goods and services today. Ask yourself how you're going to do on $12,500.
We've got a few questions here on the gold-silver ratio. The first one's quite straightforward. It's only Alswound says, does Rick see the gold-silver ratio going higher or lower over the long term?
I see it as a factoid. I see it as other than psychological irrelevant. The idea that the relative presence or absence of either gold or silver in the Earth's crust relative to each other has some impact on their value doesn't make any sense to me. As an example, most gold is produced from gold mines, so the input costs are well known. Most silver is produced as a byproduct of base metals production. Often, the silver stream on a copper mine has negligible cost. There are utility differences too. So while I think that the gold-silver ratio has psychological value, that is, it has value in the near term because people think it has value, I'm not sure what the ratio has anything to do, that the ratio has anything to do with the relative utility or hence the relative price of either commodity. What the gold-silver ratio would be useful is in a speculative situation where the silver price tripled. If the gold-silver ratio were to fall from 100 to, say, 35, the pundits for silver could say it's still undervalued. It could still go to 16:1, which is the ratio suggested by their relative abundance in the Earth's surface. In other words, it's a factoid, useful for traders, irrelevant otherwise.
I think it's that potentially useful for trading that is probably the emphasis. Callie Kitty says, I've been stacking silver. Do I need gold as well, or should I wait to convert silver to gold when the ratio tightens?
I might stack metals for different reasons than the questioners. I stack metals because of fear, and the best store of value over time has been gold. In other words, I'm looking to maintain my purchasing power. My experience has been that precious metals bull markets are led by gold. And when gold establishes momentum, and when that momentum validates the narrative in the mind of generalist investors, and generalist investors come into the precious metal space, perhaps because of its relatively lower unit cost, market leadership changes from gold to silver. As a consequence, I consider silver to be a speculative asset and gold to be an insurance asset. This sounds really conceited, I'm old and fat and rich. I don't need to get rich on silver. I need to maintain my purchasing power. So most of my physical precious metals are stored in gold, the investment portion of my physical precious metals. The speculative part of my precious metals are stored in silver because I've lived through 3 prior silver bull markets, and they're an awful lot of fun when they happen.
We have a 2-part question here from 2 different questioners blended together. One is, do you think the great taking is overblown or something that all should be concerned about? And if so, what are you doing to protect yourself from loss of ownership of stocks and in your natural resource portfolio?
I think that the great taking is a contingency as opposed to a certainty. And my suggestion is that you face greater risks that you need to address with more urgency. The greatest risk for most investors, and I've learned this by grading tens of thousands of portfolios, is their own naivete, their own lack of work. In other words, your greatest financial risk is conveniently located to the left of your right ear and to the right of your left ear. To be concerned about the great taking is something that you should address after you have addressed other things. Are you living within your means? Are you saving and investing prudently? The delta between your production, which is to say what you make, and your consumption, which is to say what you consume. It's all very well and good to say, I'm afraid of Biden or I am afraid of Trump. The truth is that neither Biden nor Trump know that you exist. The biggest determinant of your success and your failure is going to be you. So address the things within your control before you worry too much about the big picture aspects. Certainly, if you are concerned about the taking, really concerned about the taking, then you have to do something. You have to, as an example, perhaps buy physical gold and store it outside the United States so that you can protect yourself from the depredations of your own government. That is insuring against a contingency. But remember to pay attention to what you can control, and what you can control is you. The delta between what you produce and what you consume is called savings. There needs to be some. Society is not going to save for you. They're going to redistribute as much of what you have already saved as they possibly can. So you need to increase your savings, you need to safeguard your savings, and you need to invest in your own education so that you can invest those savings prudently to guarantee a future that society won't guarantee you.
Since you've been beating the drum for savings, I know you touched on this topic earlier, but it's related on this question. Will the value of the US dollar go to zero so that we lose all of our savings?
Unlikely that it goes to zero. Fiat currencies have utility, and outside a fairly small circle, many of whom listen to Dunnigan Kaiser, most of society is unaware of the concerns that we express. Remember that, as Doug Casey describes the dollar, it's a floating abstraction. It is a medium of exchange that's supported by faith. And it has a lot of faith. If you compare it with other fiat currencies, not in an absolute sense, again, quoting Doug Casey, it's the prettiest mare at the slaughterhouse. The U.S. dollar doesn't go to zero. The U.S. dollar didn't go to zero in the 1970s, but it did lose 75% of its purchasing power. The minimum wage debates that we're seeing right now are a wonderful example of that. The minimum wage in 1970, I think, was $1.25. In other words, 5 silver quarters. 5 silver quarters today would yield you $21 or $22. That isn't merely a means to advocate for silver. It's suggesting the pernicious ongoing deterioration of the purchasing power of the U.S. dollar. But I don't think that the U.S. dollar goes to zero. That doesn't mean that you should hold U.S. dollars long. They lose enough of your purchasing power that you need not to chase the yield curve. You need to confine your maturities in U.S. dollars to 1 year, 2 years, or 3 years, nothing longer than 3 years. And you hold U.S. dollars only to maintain your liquidity.
Again, that's not your nest egg, but things that you may be able to take advantage of, opportunities that should arise in the short term, or needs for some urgent liquidity needs. Okay. Changing our focus to resource stocks. There's a lot of questions here. I'm going to try to be very cherry picking here. Sian McCann asked, Rick mentioned before in terms of silver miners that if you buy the market as a whole, you go broke, which means you should be more strategic. But does he see majors like PAAS outperforming silver in a silver bull run?
Yes. Traditionally, silver needs to establish the momentum for silver stocks to run, just like gold needs to establish the momentum for gold stocks to run. What has happened in prior bull markets, I lived through 3, is that as the silver price exceeds or outpaces the inflation in the inputs to produce silver, then the margin in silver producers starts to increase. That is to say, they earn more money. At the same time, the multiple increases too, because the silver narrative has been justified by silver's price action. This combining increased earnings with an increased multiple yields really, truly quantum improvements. Dunnigan, we've talked about this on your show before, but it's worth repeating. In the silver equities, a little bit goes a long way. You don't want to overinvest in silver equities because you don't know when they're going to run, and they subject you to incredible volatility while you wait. You run a huge risk, if you're not a professional investor, in getting shaken out. Sort of like a person running a concession stand at a rodeo jumping on a bull. It's just not a good idea. When they go, they really, really, really go. It's really difficult to describe if you haven't seen it. I remember in the decade of the 70s, Coeur d'Alene Mines, 1970 was a 10-cent stock. 1980 was a $65 stock. I was too young, too dumb, too poor to take advantage of that circumstance, although I sure noticed it. By 1989, 1990, I was ready for that market. We prepared a couple ways. One, Silver Standard Resources, 72 cents to $45. The other, the aforementioned Pan American, 50 cents to $45. So by all means, buy yourself a portfolio, a small portfolio, one where you can psychologically and financially afford the volatility that you're going to enjoy, if that's the right phrase. Knowing that if we see a bull market like we've seen in the past, that portfolio of high-quality silver stocks could yield you 10-fold returns.
Related question by the same questioner. The risk-to-reward ratio and upside seems quite favorable for spot silver at the moment. I find it hard to justify to go out on the risk curve too far beyond the majors.
I don't think you need to go beyond the majors. The truth is that if we have a silver equities bull market, and I believe we will, the majors will give you 4 or 5 or 6-fold returns with very little operational risk. The penny dreadfuls will have outliers that give you 20-fold returns, or 30-fold returns, or 40-fold returns. Will you do enough work yourself to learn how to differentiate between the good, the bad, and the ugly in the penny dreadfuls? Because a portfolio of penny dreadfuls over time will go to zero. That's what will happen. An ill-chosen portfolio of penny dreadfuls in any commodity will go to zero. For most people, Dunnigan, I've graded tens of thousands of portfolios over the last 25 years. And what I've come to learn doing this is that for most people who have lives, they like to read books, they have jobs, they like to play with their grandchildren, they like to garden. They don't like to study the minutiae of penny dreadful silver stocks and familiarize themselves with local politics in Guatemala or Mexico. For those people, buying the biggest and the best, the highest quality guys, the lowest cost producers, the people with the best balance sheets, the people with a cultural history of effective reinvestment of capital. When those stocks in a bull market, the ones that exhibit minimal operational risk, can generate 400 or 500% returns over 4 or 5 years, the idea that somebody would wreck one's life or risk needing psychological help to get a 10-bagger or a 12-bagger, one wonders. Now, understand, I do a lot of work. I don't have a life. And so I do have a portfolio of what I consider to be the best of the best penny dreadfuls. But for most people, owning the highest quality silver companies and being prepared to stomach volatility, and remembering, by the way, in a silver bull market where your mind is giving you every reason to hold them, that to make the money, you must take the money, which is to say, at some point in time in the market, you have to sell these things. That's, for most people, the best course of action.
Related question here from Bearhard says, no one has the free time in their regular life to follow up on such a dynamic market of stocks such as mining. Only if you do it full-time as a professional or if you're retired. The rest don't have the realistic time for that. Make that ranking of mining stocks into a product like in your other video. So perhaps that's a shoe-in for you to pitch the various ways that people can take advantage of your hard work in this area.
We're considering doing exactly that. We have we have 2 free products that people are foolish not to take advantage of. One is the rankings itself. I welcome anybody quarterly to go to ruralinvestmentmedia.com, submit a list of natural resource stocks that you actually own, not a laundry list of stuff, but the stuff that you actually own, and I will happily rank it for you. The second thing is that I maintain a free community called the Rural Classroom with 12,000 members. You can ask each other questions. You can ask me questions. You can see 200 hours of instructional video. You can learn how to do as much work as you can stomach. But you can also take advantage of the voices of other people who do some of that work for you. Ruralclassroom.com, absolutely free.
We have one from GSDFFDSA who says, I would love to know Rick's thoughts on a specific company, Hot Chili, which I believe I was first introduced to by him on this show. Thank you so much. I'm so grateful to Liberty and Finance and Rick for all the content, especially for bringing Hot Chili to our attention.
I own Hot Chili. I own it because I think it is an enormously large copper deposit that's well located. It's not at 5,000 meters at the up in the Andes. It's 30 kilometers from the Pacific Ocean on the coast. A highway goes through it. Power goes through it. It's next to a town that's got a whole bunch of copper miners in it. Really well located. The problem is, despite the fact that it's very large, it doesn't have, so far, a discovered high-grade core. The capital costs to put this thing into production are going to be gigantic. And the capital costs associated with desalating the seawater necessary to process it are going to be gigantic. If there were a high-grade core so that your return on capital took place quickly, this would be a no-brainer. I own the stock because I know geologically that within a cluster of deposits of this size, a high-grade core exists, but they haven't found it yet. If I'm wrong, or if they don't find it over time, I will lose money on this investment. If I'm right, I'll see a 10-bagger. I have room in my portfolio for binary questions where if I'm wrong, I lose 30 or 35%. If I'm right, I make 1,000%. Hot Chili operates in that portion of my portfolio. Huge, huge proven resource, going to get much larger. Will they find a high-grade core? If so, when will they find a high-grade core? If they find a high-grade core, game is on. If.
Question here from Z Saltspuko, who says, what is Rick's take on Helmerich Pain, HP, and ranking if he has one?
I don't rank Helmerich Pain because traditionally I have not been a great investor in oil field service and supply companies. I own Helmerich Pain. Many years ago, I spent a lot of time with Hans Helmerich, who was a superior human being. I like the fact that Helmerich Pain is still regarded as the sort of gold standard in drillers, which is to say land drillers, if they have a technical challenge, often go to Helmerich Pain in preference to other people. And I love the balance sheet. I love 3 generation of focus on a great balance sheet. I love the fact that they invest heavily in down cycles in the market, and they take advantage of up cycles in the market to sell their second tier or dated equipment to other operators. If you believe that the land drilling business in the United States will improve, which is to say, if you believe that the Permian and the Eagle Ford and stuff like that will see an uptick in utilization, then Helmerich Pain is a great stock.
Manfred H.S. Rick recommends oil and gas stocks and says the Canadian stocks are silly cheap. Which do he recommend after the Canadian election?
My worst fears were confirmed in the Canadian election. Mark Carney has the same ideological preference as his predecessor, Justin Trudeau. Unlike Justin Trudeau, Mark Carney is very competent. I would prefer an incompetent enemy to a competent enemy. Mr. Carney is a very shrewd political operative. I've met him twice. He's an extremely impressive human being, and he is an enemy of the oil and gas industry. Despite the fact that by most conventional valuation metrics, at least the sophisticated metrics, including recycle ratio, the Canadian industry is substantially cheaper than the U.S., risk-averse investors need to concentrate south of the border, where the executive at least says nice things about the oil and gas industry, rather than north of the border, where the current prime minister seems to favor the extinction of the oil and gas industry. That said, I own a basket of Canadian oil and gas stocks. Sometimes hope wins out over probability.
Question from Diogenes. Would investors who don't want to select their own mining stocks be well advised to buy the new GBUG ETF?
I think probably the answer is yes. I believe that we're in the early innings, perhaps a quarter of the way through, a really important precious metals bull market. If I'm right, and if investors are unwilling to do the work to separate in movie parlance the good, the bad from the ugly, being invested in GBUG, taking advantage of the 5 decades of experience evidenced up by John Hathaway, and his protege, Justin Tolman, who used to work for me, that's not a bad idea. I wouldn't own it because that portfolio owns some names that I personally wouldn't own. The idea that I pay a fee to have somebody assemble a portfolio that includes stocks I wouldn't own seems inelegant. But the truth is that I believe that we are coming into a precious metals bull market that's really, truly one for the ages. And one needs to be involved in that. The alternative to owning GBUG, is to lower one's return expectations, but lower one's risk profile, and simply compose a portfolio of the highest quality, finest gold mining companies in the world. Content oneself with a 500% appreciation over 10 years, as opposed to some higher number that exposes you to more risk.
We've got a question here from Passive Income Coach. I would love to know the pros and cons of investing in miners through either owning the stock itself or to leverage using CFDs or options and gain exposure to more stock during the bull run.
I'm the wrong one to ask that question of. Options trades are arithmetically and in probabilities poor trades. With an option, you are betting on an event, but you're also betting against time. And the decay in options, decay meaning the time value of money in options, is an ugly foe. In second-year university, I was taught by a finance professor that 98% of all options contracts ever written, if held to maturity, expire worthless. That seemed to me, as a second-year student, as a 19-year-old student, as taking a bet against 50 to 1 odds. And the consequence of that is that with very few exceptions, pardon me, over the last 50 years, I have been a consistent seller of options and not a consistent buyer of options. If I have a bullish bias, I am tempted to sell above market calls, and I'm tempted to sell below market puts. The most frequent outcome is that both the put and the call, because I sell short-dated ones, expire worthless. I grab the premium and I use that to reduce my exposure, my cost in the underlying position. The quantum gains, of course, are made by defying arithmetic and by buying options. I have only known 2 rich traders in my life, and they're both alive today. They are both geniuses. I am not a trader. I am not a genius. I'm a plotter. So I would ask the questioner whether or not he or she self-identifies as a genius. And if the answer is yes, go your best lick.
So since you're talking about what you are, the real rye bread says Rick Rule is the sharpest tool in the shed. Most of the juniors and other miners are unavailable at many brokerages. Is there a preferred or recommended brokerage house that allows access to all or most mining stocks?
The firm that I used to run, which is to say Sprott Wealth Management, is one such firm. You should decide for yourself whether or not their services are worth the fees that they charge you relative to interactive brokers. I use both. I have a lot of money at Sprott. I value the advice, particularly of Justin Tolman. There are a bunch of brokers there who I brought up, so I consider them to be well brought up. The alternative to that is to utilize the free services at places like the Rule Classroom and utilize interactive brokers. I mention interactive brokers because interactive brokers is a platform where you can trade Australian stocks, British stocks, Canadian stocks, American stocks, all that kind of stuff. The customer-facing interface is very difficult for an old Luddite like me. You need, if you use interactive brokers, to have some technical, by technical, I mean computer skills, or you need access to a son or a daughter or a niece or a nephew or some young person who's more facile with technology. But I can recommend interactive brokers as a trading platform for those who have some degree of technological sophistication. I use it every day.
Turning the attention to Battle Bank, there are several questions submitted by viewers. We're going to just get to a couple of them. Christopher K. says, when can I get a loan from Battle Bank on my gold? At approximately what interest rate?
We believe that the FDIC, the OCC, and the Fed will license us to operate in June or July. Believe me, we're ready to go. We've had 4 years to get ready for this. And that is a product that has already been designed. In other words, we don't need to design the paperwork. We don't need to design anything. We're actually setting up the infrastructure to do it with some of my money, although I don't need to borrow money to buy gold. I'm going to do that. I'm going to deposit some of my own gold there and take a loan against it just to see how the system works. So if it screws anybody up, it'll screw Rick up. We would expect the bank to be open for business in June or July.
Felix the Cat 69 says, I would like to know how he's going to make it easy to get metals to a Battle Bank approved vault. It's difficult sending metals myself. USPS will only insure up to $50K, and other carriers won't insure PMs. They have to be picked up by Brinks or Loomis. Monetary Metals does not charge for this service.
There are Brinks or Loomis locations in 10 or 12 places around the country. Those vaults are fairly accessible. I would suggest to the questioner that if the value of the metal that they propose to ship substantially exceeds $50,000, that they use a private courier at any rate. Remember that we can't loan against physical metals that we don't receive. You don't want your collateral to become the property of some thief. The cost to ship metal relative to the value of the metal is very, very small. Understand that borrowing against precious metals is not meant to be a trading activity. It's meant to allow you to access liquidity on an asset that you plan to hold for 5 or 10 years. What that means is that if you amortize the cost of the shipment over either the interest that you will pay me or the price appreciation of your physical precious metals over 5 or 10 years, the amount of cost becomes de minimis.
And Rick, before we let you go, any re-upping by you of your offers that you've extended to our viewers in the past to grade their natural resource stock portfolios?
Absolutely. I learn as much doing that as I teach. If you care about my opinion of natural resource and precious metals investing, you can personalize it. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks. If we follow it, I will rank it for free, 1 being best, 10 being worst. I will comment on individual issues if I think my comments might have value. Please, 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 folks, no crypto, no tech stocks, no narcotic stocks. I haven't done due diligence on marijuana for almost 60 years. I'm way out of date there. So leave an old man with a topic that he can do well. Natural resource stocks only.
We're grateful always, Rick, for your presence here on Liberty and Finance. And folks, you'll find a link to take advantage of Rick's free resource portfolio grading offer in the description of this video, as well as info about Battle Bank. Remind people how they can find out more about Battle Bank.
Battlebank.com, best place. Go to the source, battlebank.com. Failing that, if you send in your portfolio to Rule Investment Media in the question and comment section, simply write bank.
Very well. Rick, thank you for joining us again on Liberty and Finance.
Thank you, Dunnigan. Delighted to be with you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 19th through May 26th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.